Have you ever wondered how commission-free investing platforms like M1 Finance actually stay in business? It seems counterintuitive, right? They let you buy and sell stocks, ETFs, and even crypto without charging a dime per trade. So, where's the catch? How do they keep the lights on, pay their employees, and continue to innovate in the competitive world of fintech? It's a question that many investors, especially those new to these modern platforms, often ponder. In a financial landscape where traditional brokerages historically charged significant commissions for every single transaction, the rise of free trading has been nothing short of revolutionary. It's democratized investing, making it accessible to millions who might have been deterred by high fees. But this accessibility doesn't come out of thin air. There's a sophisticated business model at play, one that leverages various financial mechanisms to generate revenue while still offering a compelling, low-cost experience to its users. Today, we're diving deep into the intricate financial engine that powers M1 Finance. We're going to pull back the curtain and explore exactly how M1 makes its money, focusing on two primary, yet often misunderstood, revenue streams: interest and interchange fees. But it's not just those two. We'll also touch upon other crucial components of their business model, giving you a comprehensive understanding of how they thrive in a seemingly free market. Understanding these revenue streams isn't just about satisfying curiosity. It empowers you as an investor. When you know how a platform makes its money, you can better assess its incentives, its long-term viability, and whether its interests truly align with yours. It allows you to make more informed decisions about where you entrust your hard-earned money. So, let's start with the big one, the one that often surprises people because it's not a direct fee you pay: interest. Now, when we talk about interest, it's not just a single, monolithic source of income for M1. It's multifaceted, stemming from several different avenues within their ecosystem. First, and perhaps most significant, is interest on margin loans. M1 offers its users, particularly those with a certain level of assets, the ability to borrow money against their investment portfolios. This is known as a margin loan or a portfolio line of credit. Imagine you have a portfolio worth $10,000. M1 might allow you to borrow a percentage of that value, say $3,000, at a specific interest rate. This interest rate, while often competitive compared to traditional personal loans or credit cards, is a direct source of revenue for M1. Think about it this way: M1 leverages the assets held in its users' accounts as collateral. This significantly reduces their risk compared to unsecured loans, allowing them to offer lower interest rates to borrowers while still making a profit. The spread between the interest rate M1 pays on its own borrowings, if any, and the rate it charges its users on margin loans is a key profit driver. And here's the kicker: these margin loans are designed to be flexible. Users can borrow instantly, pay back the principal anytime, and are only billed for interest monthly. This convenience encourages usage, further contributing to M1's interest income. For investors looking for liquidity without selling their assets, a margin loan can be an attractive option, and M1 capitalizes on that need. Beyond margin loans, M1 also generates interest from cash balances held on its platform. When you deposit money into your M1 account, whether it's in your investment account before it's invested, or in their M1 Spend high-yield cash account, that cash doesn't just sit there idly. Like traditional banks, M1, or its partner banks, takes that uninvested cash and earns interest on it. They typically deposit these funds with partner banks, which then invest the money in low-risk, interest-bearing assets like government securities or other short-term instruments. The interest earned on these cash balances is then a revenue stream for M1. While M1 passes on a significant portion of this interest to its users through competitive APYs on its high-yield cash accounts, especially for M1 Plus members, they retain a portion to cover operational costs and generate profit. This is a common practice across the financial industry, and it's a stable, predictable source of income, particularly when interest rates are higher. The incentive for M1 is to encourage users to keep more of their uninvested cash on the platform, which is why they offer attractive APYs. Another, less obvious, but equally important source of interest income comes from securities lending. This is where M1, like many other brokerages, may lend out certain securities, stocks or ETFs, held in customer accounts to other institutions or traders. Why would someone want to borrow a security? Often, it's for short selling, where a trader borrows a stock, sells it, hoping its price will drop, then buys it back at a lower price to return to the lender, profiting from the difference. When M1 lends out these securities, the borrower pays M1 a fee or interest for the loan. M1 then shares a portion of this interest with its users who have opted into securities lending. While users retain ownership rights of their securities, this practice allows M1 to generate additional revenue from assets already on its platform. It's a way to put otherwise dormant assets to work, creating a win-win scenario where both M1 and participating users can earn extra income. M1 states they only lend out a small percentage of total capital and focus on high-demand securities, optimizing for this revenue stream. So, you can see, interest, in its various forms, is a substantial pillar of M1's revenue model. It's a testament to how financial institutions can generate income without necessarily charging direct, explicit fees to their customers for core services. Now, let's shift gears to another fascinating and often overlooked revenue stream, interchange fees. This primarily comes into play with M1's banking and spending products, specifically their debit card and, more notably, their owner's rewards credit card. What exactly are interchange fees? Every time you swipe your debit or credit card, a small fee is charged to the merchant by the acquiring bank, the merchant's bank. A portion of this fee, known as the interchange fee, is then passed on to the issuing bank, the bank that issued your card, in this case, M1's partner bank. M1, in turn, receives a portion of this interchange fee from its partner bank. While the individual interchange fee for a single transaction might be tiny, typically a small percentage of the transaction amount plus a fixed cent amount, these fees add up significantly across millions of transactions. The more people use their M1 debit or credit cards for everyday purchases, the more interchange fees M1 generates. This is a classic example of a network effect business model, where the value of the service increases with the number of users and transactions. With that said, thanks for watching and until next time.